In the financial world, taking out a loan can be seen as a practical path to achieving various life goals, such as purchasing a home, pursuing higher education, or even starting a business. However, the very clarity of this path can become mired in complications should one find themselves unable to keep up with loan payments. Today, we delve into the repercussions of falling behind on these obligations and explore specifically what options become unavailable in such scenarios. Imagine this. You've taken out a loan and due to unforeseen circumstances, a sudden job loss, an unexpected medical expense, or any number of life's surprises, you find yourself struggling to keep up with your payments. The first apparent consequence is a hit to your credit score. This is the numerical embodiment of your financial credibility, and it drops swiftly as tardiness in payments is reported to credit bureaus. A lowering credit score doesn't just showcase a history of untimely payments, it dramatically diminishes your borrowing power. The options for new lines of credit, more favorable loan terms, or low interest rates fade rapidly from your grasp. Furthermore, as the missed payments accumulate, you might find yourself barred from refinancing opportunities. Refinancing serves as a strategic maneuver to obtain better interest rates and thus lower monthly payments, making a loan more manageable. Yet lenders are unlikely to extend this option to someone they perceive as a greater financial risk. Essentially, the opportunity for refinancing altruistically aimed at improving your financial situation disappears when you need it most. For homeowners, the specter of foreclosure looms large when mortgage payments are in arrears. To preemptively tackle such dire outcomes, various assistance options typically exist, such as forbearance, loan modification, or even repayment plans. However, the ability to effectively negotiate these options is severely curtailed once late payments become habitual. Lenders are generally more inclined to work with borrowers who demonstrate proactive communication and partial payment efforts, which might not be feasible when you're significantly behind. In consumer loans, be it a car or personal loan, repossession enters the picture as an existential threat. Once the warning letters accumulate unanswered, the lender's recourse may turn to reclaiming the asset in question. This act strips not just the property, but the tangible resources or conveniences tied to it, further exacerbating financial woes. Here again, the options to negotiate more lenient repayment terms or to possibly defer payments in a structured way disappear the longer the lapse in payments persists. Concluding this examination, it's vital to recognize how the domino effect of missed payments can severely limit your financial flexibility. The opportunities for refinancing, negotiating advantageous terms, or even partaking in assistance programs all hinge on maintaining dialogue and not letting communication break down with lenders. Once a pattern of late payments is established, these financial cushions shrivel, replaced by strict measures and legal proceedings focused more on recovery than relief. In any challenging financial situation, remember the saying, "A stitch in time saves 9." Addressing difficulties early can mean the difference between temporary discomfort and enduring hardship. Recognize and act swiftly to mitigate the impact of late payments, thus ensuring you retain as many options as possible to navigate your financial journey successfully.